So a sweep checking account functions like a regular checking account, but what this does is with a normal amortized loan, if you put chunks of money on your balance to save interest and save time, that's a wonderful disciplined approach on an amortized loan. But the reason why that becomes an untenable solution for a lot of people is because if you put $5,000 more monthly on your mortgage than what your payment requires, you can't dip back over into that mortgage and pull some money out in the event that you need to borrow or in the event that you want to have if you have an emergency or you got kiddos going to college. The all-in-one tears down that wall, and now what happens is on a monthly basis, any money, let's call it your payroll, any payroll or income that comes into this checking account, okay? Any money that comes into this checking account on a nightly basis is swept over to your line of credit, and it reduces your balance on a nightly basis, thereby reducing your interest cost. Because once income comes into the checking account and it sweeps over, it reduces your balance, and then your interest, your nightly interest calculation is now based on what your balance actually is. And then what happens is every 30 days, the line of credit looks at, okay, what's been your nightly interest calculation on this line of credit, and that becomes your payment due. The reason why that's a big deal in mortgage lending and in being fiscally disciplined is because if you want to attack the principal and pay that thing off rather quickly, this allows you to do it without fear of losing access to those equity dollars that you're creating by reducing your balance.